navigating through economic depressions, learning from the past. Understanding economic depressions. Economic depressions are devastating periods of economic decline that impact societies on a large scale. They are characterized by significant contraction in economic activity, high unemployment rates, and financial instability. Understanding the causes and impact of economic depression is crucial for individuals and governments to navigate these challenging times. By studying historical depressions and analyzing recovery strategies, valuable lessons can be learned to guide preparations for future economic challenges. Causes of economic depressions throughout history. Economic depressions throughout history have been caused by various factors. Common causes include financial market crashes, stock market collapses, excessive borrowing and speculation, trade imbalances, natural disasters, and geopolitical events. These events can lead to a sudden decline in economic activity, businesses failing, increased unemployment, and a decrease in consumer spending. Understanding these causes is essential to prevent and mitigate the impact of future economic depressions. Impact of economic depressions on societies. During economic depressions, societies experience significant social and economic consequences. Unemployment rates rise, leading to increased poverty and inequality. Access to basic necessities, such as healthcare and education, becomes challenging for many individuals. Crime rates tend to increase as desperation for survival take hold. Families and communities also suffer as they struggle to make ends meet and maintain their quality of life. The social fabric of society is strained, leading to increased social unrest and dissatisfaction. It is crucial for governments and communities to address these issues and provide support to those affected by economic depressions. The Great Depression of 1929. The Great Depression of 1929 was a severe worldwide economic depression that lasted throughout the 1930s. It was triggered by a collapse in the stock market and resulted in high unemployment rates, bank failures, and a decline in global trade. Individuals and businesses suffered from substantial losses, leading to widespread poverty and economic hardship. Government interventions and recovery efforts were necessary to stimulate the economy and stabilize financial markets. Factors leading to the Great Depression. The factors leading to the Great Depression of 1929 were complex and multifaceted. Some of the key factors include speculative stock market practices, excessive borrowing and spending, unequal distribution of wealth, and the collapse of the agricultural sector. These factors, combined with weak government regulations and international economic instability, created the perfect storm for the economic downturn. Government interventions and recovery efforts during the Great Depression. During the Great Depression, the US government implemented several interventions and recovery efforts to address the economic crisis. One of the key initiatives was the New Deal, a series of programs aimed at providing relief and recovery measures for the unemployed and stimulating economic growth. The government also implemented regulations to stabilize the banking sector and introduced social security measures to provide a safety net for citizens. These interventions helped to alleviate some of the economic hardships and lay the foundation for recovery. Lessons from the 2008 financial crisis. The 2008 financial crisis highlighted the importance of regulatory oversight and risk management. It demonstrated the need for stricter supervision of financial institutions and the potential consequences of risky lending practices. governments learned the lesson of the need for proactive and coordinated fiscal and monetary policies to stabilize the economy. Individual investors were reminded of the importance of diversifying their portfolios and being cautious of excessive debt. The crisis emphasized the need for transparency in financial markets and the importance of consumer protection. Similarities between the 2008 financial crisis and historical depressions. The 2008 financial crisis shares some similarities with historical depressions. Both were triggered by excessive speculation and risky lending practices. In both cases, there was a collapse of financial institutions and a severe reduction in economic activity. The crisis also led to a global recession, similar to the global economic downturn experienced during historical depressions. These similarities demonstrate the cyclical nature of economic depressions and the importance of monitoring and regulating financial markets. Changes in economic policies. Post-2008 crisis. Following the 2008 financial crisis, there were significant changes in economic policies to prevent a recurrence of such a crisis. Governments and financial institutions focused on strengthening regulation and oversight of the banking industry. The Basel III framework was, after the 2008 financial crisis, there were significant changes in economic policies to prevent a recurrence of such a crisis. Governments and financial institutions focused on strengthening regulation and oversight of the banking industry, introducing the Basel III framework to ensure banks maintain higher capital levels and implement risk management practices. Additionally, there was increased emphasis on transparency and accountability in the financial sector. These policy changes aim to create a more stable and resilient financial system to mitigate future economic crises. During economic depressions, it is crucial to employ strategies that can help you navigate the challenging times. One important strategy is to diversify your investments and not rely heavily on a single sector. Additionally, effective risk management is vital to protect your assets. Governments can implement fiscal and monetary policies to stimulate economic growth and provide support to affected industries. It is essential to adapt and be proactive in mitigating the impact of economic depressions. When navigating economic depressions, it is crucial to understand the importance of diversification and risk management. By spreading your investments across different sectors and asset classes, you can minimize the impact of a downturn in any one area. Moreover, implementing effective risk management strategies helps protect your assets and mitigate potential losses. Diversification and risk management are key to safeguarding your financial stability during economic challenges. During economic downturns, governments and central banks play a crucial role in implementing fiscal and monetary policies to stimulate the economy. Fiscal policies involve government spending and taxation to boost aggregate demand, while monetary policies involve adjusting interest rates and controlling the money supply. These measures aim to encourage consumer spending, investment, and lending, which can help revive economic activity and mitigate the negative effects of a depression. Japan and Iceland are examples of countries that successfully recovered from economic depressions. Japan faced a prolonged period of economic stagnation known as the Lost Decade during the 1990s. However, through a combination of fiscal stimulus, monetary easing, and structural reforms, Japan was able to revive its economy. Iceland experienced a severe economic downturn following the 2008 financial crisis, which led to a banking collapse and a sharp decline in GDP. However, Through a combination of fiscal measures, such as debt restructuring and capital controls, and structural reforms, Iceland was able to stabilize its economy and achieve a strong recovery. These case studies emphasize the importance of implementing a combination of fiscal and structural measures to successfully navigate economic depressions and achieve sustainable recovery. In conclusion, economic depressions have long-lasting impacts on societies and governments. Understanding the causes and lessons from historical depressions can help individuals and governments navigate future economic challenges. It is crucial to diversify and manage risks while implementing effective fiscal and monetary policies to mitigate the effects of downturns. By being prepared and proactive, we can navigate through economic depressions and build a more resilient future. Individuals should prioritize diversification of their investments and actively manage risks to safeguard their financial well-being, while governments should implement effective fiscal and monetary policies to support the economy and affected industries. During economic depressions, it's important for individuals to diversify their investments and manage risks to protect their finances. Governments should implement effective fiscal and monetary policies to stimulate economic growth and support those affected by the crisis. To prepare for future economic challenges, individuals should focus on building a strong financial foundation by maintaining an emergency fund, diversifying investments, and continuously upgrading their skills. Governments should prioritize creating policies that promote economic stability and resilience, such as investing in infrastructure and education. By being proactive and adaptive, both individuals and governments can navigate and mitigate the impact of future economic downturns.